The thing I want to cover now is the question of zeroing in on the long-term significant outperformers and also avoiding the big losers. My name's Garry Davis. As always, this is general advice only. Now, there are two sides to investment success. One is owning large long-term winners. The reality for just about everybody on the planet is that most of the money you'll make over the next decade or 2 decades will come from a small handful of stocks. It will not come across the board. It just doesn't work that way. You'll find that 80 or 90% of the profit you make in the next decade might come from 10% of the stocks that you own. So therefore, you want to own really good ones, and you want to own them in a way that allows that long-term potential to unfold. But you can make life so much more productive for yourself by avoiding the biggest losers. Just avoiding the big losers by not hanging on to something that loses 70, 80, 90% of its value. That in itself is just a massive step forward as an investor. So I've put this up on the chart as zero because zero is certainly one of those kind of long-term stocks that are going to continue to create wealth at a well above average rate. But before I do that, let's just look at where the current situation is. And I'm sure everyone's heard of value investing versus growth investing. And value investing is always attributed to, well, that's how Warren Buffett does it. But I'm not sure that he does, to be honest. Some aspects of it he does, but not in the sense of slavishly only buying undervalued stocks. Because value investing over the last 5 years minimum is lagging badly as a concept. The fund managers who focus on buying value only without paying attention to growth have done really badly. Now, I sort of get what value investing is about. It's paying 80 cents for something that's worth $1. I get the logic of that to give you a margin of safety. But the reality is this. It's not what the market has rewarded for the last 5 years. And value managers have lagged badly. So the ones that have followed that philosophy have got very little to show for it. The question is, on a big picture level, is this a temporary aberration or is it something much, much longer term, as in decades? Now, my view is that it's decades. And therefore, you should focus far more on growth than you should on value. So I'm not saying that you abandon either. It's a combination of the two. If you can get strong growth and you can buy some value as well, in other words, you buy at a PE level that's less than their rate of growth, then that's a good thing to do. And the reason that I think that it's decades long is that we've got some new themes that are century kind of themes. Artificial intelligence is one of them. It's an enormous game changer. It's not going away anytime soon. And the companies that most benefit from AI are going to do extraordinarily well. And then we've got this other theme about decarbonisation. And both of those themes, they only come around once every 100, 200, 300 years. We've got two of them running together. They're so powerful and they're so assured that I think the status quo in terms of value investing, value-only investing, has been disrupted for a very long period of time. And that's why most of the time you only ever hear me talk about growth. All I've been talking about for the last 5 to 10 years is growth. Because to me, if you've got strong assured growth, then it papers over the cracks. If you pay a bit much for it, okay, you might be underwater for a little bit, but it repairs itself and everything marches on. I think the runways for growth in these two areas of AI and decarbonisation are just so large and so highly probable that higher than normal multiples can be justified. And it was early in 2023 that I started to shift my thinking towards being able to embrace the stocks trading on seemingly very high multiples, multiples that for years had put me off. But I started to understand that the market is prepared to pay up for that sort of high growth and highly probable growth. Just is how it is. Let's call them what they are. These stocks are the world's great wealth compounders. If you own just a couple of them, you don't need to own 10 of them. You just need to own 1 or 2. You own them for more than 10 years, you're probably going to almost certainly generate a lot of wealth What are the characteristics of these sort of stocks? Look, there are many aspects to this, but these are some of the main ones that I look for. They typically have the largest market share in their particular industry, so they are a market dominator. They have huge runways for growth. So some companies are market dominators, but they're so mature that there isn't a lot of growth left. You can still need huge runways for growth, the ability to diversify into new verticals, new geographies, whatever it might be. They outperform their competitors in brand, profitability, perceived value, etc., etc. So they have a wide economic moat. You'll find a lot of these companies have some sort of network effect. In other words, the growth, REA is a great example. What used to be called realestate.com is a great example. There's 2 or 3 companies in Australia where you can list your property. Where are you going to go? Where are you going to list your company or your house if you want to sell it? You're going to list it with REA probably, because why wouldn't you want the most eyeballs on your property? And so the big get bigger. It's a network effect. It feeds on itself. So companies that are in that position are almost unassailable. And they can impact consumer preferences. They can solve customer problems and meet customer need. You generally find that they're pretty innovative. If you look at the companies that I'm about to show you, Apple, Microsoft, etc., they're innovative, and that adds value. They have strong management to realize the potential that they have. And another one, of course, is they have very clear pricing power. They're not held back by recession. They're not held back by government policy. They have clear pricing power. So if you identify stocks that look like that, then at least you're a chance. It doesn't guarantee it, because over time that there are not that many Apples, Microsofts, or CSLs, etc. But let's look at what has happened with some of these stocks. And I've gone back 15 years. 10 didn't seem quite enough. 20 seemed like a bit too far out, so I settled on 15. CSL has provided a 10-fold gain over the last 15 years. Apple, a 28-fold gain over the last 15 years. Now, it's had several events, 1, 2, 3, 4, where the price has gone down by between 30% and 50%. So it's not necessarily that easy to live with these stocks. You've got to have a plan for how you're going to tap into this sort of potential. But that's okay. That's only just about forward thinking and clarity around what you're doing, and then the discipline to stick to it. It's not that hard. You just got to get organized. Microsoft, 15-fold gain over the last 15 years. So there are a lot of the stocks that I've sort of looked at over the years. So they're the great ones. Where are the next ones, and how do you live with them? So if we look at Microsoft, superb management from the get-go. They certainly solved a vital need and led a powerful new trend in computers and software and the internet. They retained pricing power irrespective. And they have an almost never-ending runway for success. But the real question is, how do we know in the early years, back in 2005, 2010, how did we know that Microsoft was going to do this, that it was going to give us that sort of return? And the answer is we don't. And if you think you do, then you're kidding yourself. So the answer is that we build a basket of likely candidates, knowing that we've got a good chance that out of, let's say, we build a basket of 10 or 15 or 20 of these sort of stocks, that a couple will emerge, that we'll get 1 or 2, that will be another Apple or another Microsoft or another CSL. And then we hold them and we manage them in a way that is acceptable to us, to our psychology. And if they fall off the perch, then fine, get rid of them. But what you're looking for is the couple that are going to make you great wealth, and you want to stick with them. And that's what I do in the Insiders Club. That's what I do personally. And that's, as long as you guys keep asking the questions, that is what I will continue to do in Portfolio Analyst. So let's look at some of the other ones that you could say, well, they've achieved this now. PME, go back 15 years, it's well over 100-fold gain. Now, it's coming off such a low base that can almost be a bit misleading, but it's been an incredible journey from, way, way under $1 to $140. And whilst I wouldn't be buying it at the current level, there's absolutely no reason why PME can't continue. Now, not at the rate that it has been. That rate will slow. But I think this now can be put in that category that CSL is in.